Disney just released their latest quarterly figures, and to be honest, for the quarter they were quite good. Guidance, there were some, let's say, worrying comments, which is why the stock is down, well, now 2.26%. It's between 2 to 4%. At the time of making this video, the stock is still down 2% year to date, but up 2%, 2.7% year over year. Has a market cap of $164 billion, a forward PE of 17.5 times, much lower than its 5-year mean, 11.3 times EV to EBITDA, also lower than its 5-year mean. Basically, everything is lower because there was that period of unprofitability because of the streaming platform, which now becomes a bit more profitable, which is also why you're seeing price earnings to growth under 1, which in my opinion is quite cheap. Now, this is a company that, well, when you look at sales growth or the expectations for sales growth from the analysts, it's not growing that fast, right? For fiscal year 2024, close to 3%, then fiscal year 25 and 26, around 5%. But it's the bottom line that grows much faster. It's the company's free cash flow that is growing much faster, and that's basically why you would be inclined to buy Disney today. Because it is valued as a company that might not grow that much, but from a profitability standpoint, they could still have a couple of levers to pull and become more and more profitable. Plus, we're still talking here about Disney, one of the biggest brands, most known brands around the world. And at the time of making this video, the average analyst price target sits close to 40% higher than the price we're at today. Now, of course, with Disney, I think we can all admit that there is a little bit of brand damage because of some political stuff, agenda, their content, etc., etc. But in my opinion, they are changing a little bit, especially with regard to the content. It's more now about quality and less about quantity. Yes, Star Wars still sucks, let's be honest. But if we look at the other shows, if we look at Hulu, for example, great TV shows there. Shogun, The Bear, elite TV shows. I highly suggest you go watch it if you have not done so. They're also releasing quite good movies that perform very, very well in the box office. Deadpool and Wolverine, probably going to go for records in the box office. Inside Out, $1.5 billion, I think the #1 animated movie of all time. So they're doing quite well. Again, it's all about quality and less about quantity, because previously we had way too many movies come out, way too many TV shows. There was superhero fatigue, let's be honest, plus the quality of those shows, of those movies came down. Yes, the writing was not really up to the levels that we were used to. The previous 10 years ago, 15 years, they had quite a good run, let's say, quite a good run. My opinion, the Marvel acquisition for around $2 billion, one of the best ones out there, because, well, just the Avengers movie, the Endgame and Infinity Wars, I think they brought in close to double that, something like that. So quite a good move. This Fox one, not so much, quite expensive. But okay, that's in the past. Let's see what happens in the future. We'll go over all the numbers for this quarter. Leave your thoughts down in the comment section below. Like, subscribe, notification bell on, do all of that. We already covered Shopify. Shopify had a great quarter. Airbnb, good quarter, bad guidance. All of those videos will be in the top right corner. If you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. And so overall, for the quarter, mostly beats, right? The only misses were experiences. That's a miss of 2.5%. Experiences operating income also missed 4.4%. Operating margin 52 basis points. Free cash flow missed by 30.3%, so that's quite a big miss. Subscribers, a miss by 0.3%, so not by much. And ARPU Disney Plus Core by 0.4%. All the rest were beats. Now, it's also important to note that for the Disney streaming bundles, there will be some price increasing. Basic Trio bundle and the Premium Trio bundle, there will be an increase starting in October. They're really pushing towards you not paying for individual streaming services, but to take a bundle. If you want more information here, you've got Disney Plus Basic, Premium, Hulu with ads, or Hulu without ads. All of those will increase in prices. Yes, I do think that eventually we are going to be bombarded with ads on each and every streaming service, unless we are willing to pay a bit more to get no ads. But of course, ads are extremely lucrative for streaming businesses, so I understand why they're doing it. Plus, if you don't mind ads, then that means you will be able to watch Disney, Hulu, Netflix, whatever, for a cheaper price. Now, here they talk a little bit about what's coming up for them. So, of course, they've got one of the best IPs out there. So, Toy Story 5 is coming in 2026. I didn't know they were doing another Toy Story, but okay. Avengers, there has been a small change there, so we're now getting Avengers Doomsday with Robert Downey Jr. Who, big surprise. Who would have guessed it? Who would have guessed? Of course, they went back to Tony Stark. Well, it's not Tony Stark, it's Robert Downey Jr. He's coming back as Doctor Doom. How is it possible? Didn't he die in the Endgame? Well, yes, but multiverse stuff. So there is that. The Kang Dynasty is not going to happen because of the controversy of the actor. So there is that, but I do still think these two movies will perform quite well. There's also Fantastic Four, etc., etc. Star Wars, I'm not going to talk about that because that franchise is going down the drain. And then we still have some Avatar movies coming up in 25, 29, and 2031. So yeah, still a long, long way to go for that one. As for the results for the quarter, revenue is up a little bit. Income before income taxes is up quite a lot. Total segment operating income is up, EPS is up, and diluted EPS excluding certain items is up as well. More on those things in just a second. Disney Plus core subscribers and ARPU. So we've got Disney Plus domestic, they increased by 0.8 million versus the prior quarter. ARPU decreased by 26 cents versus the prior quarter due to impact of subscriber mix shift. As for Disney Plus International, subscribers decreased 0.1 million versus the prior quarter, but ARPU increased by 12 cents due to increases in retail pricing. As for the sports segment of the business, they say your advertising revenue growth of 17% is attributable to increases in rates and sponsorship revenue, growth in subscription revenue due to higher rates as well, and an increase in programming and production costs primarily attributable to the NBA and Stanley Cup finals. As for Star India, which you can see here in the yellow, which is still negative, there was an increase in operating loss versus the prior year. That's due to higher programming and production costs attributable to the timing of the ICC T20 World Cup, a decrease in affiliate revenue due to lower effective rates, and growth in advertising revenue reflecting the timing of that ICC T20 World Cup. As for the experience segments, still doing quite well, but operating income did decrease. Why is that? Well, higher costs driven by inflation, increased technology spending, and new guest offering, partially offset by the comparison to depreciation in the prior year for Star Wars: The Galactic Star Cruiser. As for the second point, guest spending growth attributed to increases in per capita guest spending at their cruise line. The cruise line is doing quite well for Disney for various quarters now. As for international parks and experiences, well, operating income were comparable to the prior year due to increases in attendance and occupied room nights, guest spending growth due to higher per room spending at their resorts, and higher costs due to new guest offering, inflation, and increased depreciation. Of course, if you've been to a Disney park more recently, or at least in the last couple of years, you know it has become extremely expensive. And so overall revenue increased 4%, total segment operating income 19%, diluted earnings per share excluding certain items 35%. But as we've seen before, well, free cash flow is positive, but it's down 24% year over year. As for the different segments, entertainment revenue up 4%, sports revenue 5%, experiences only 2%. And as for operating income in those segments, entertainment is up 100%, so they're doing much better with that. Finally, sports down 6% and experiences down 3%. So overall, total segment operating income is up 19%. I did note a couple of things from the earnings call. So parks and experiences revenue slowed down slightly after a strong Q4. Entertainment driving overall growth, offsetting the slowdown in parks. As for sports, Disney secured the NBA Finals for another 11 years and has 1 year left on the current deal. As for streaming, Disney Plus will launch a flagship direct-to-consumer product by the end of 2025. The platform is expanding content offering, including news, and will raise prices due to increased content popularity. The ad market is strong, and Disney is developing new technology to sell ads across streaming platforms based on audience data. And so right now, looking at the graph, RSI is very low on the weekly, not yet oversold, but quite low, we're back to a point where previously here, December 2022, we did see a little rebound. Now this candle is quite interesting on the weekly. Let's see if that can hold and not transform into a red one. Overall, if you're buying Disney today, you're buying, well, one of the biggest brands on the planet that is trying to turn its whole business around. Now, the tricky part here is that, well, if we're going into a recession, a mild one doesn't matter, then, well, people will be quite picky if they are going to spend a lot to go to a Disney park, if they will be willing to extend their subscription for Disney Plus after the price hikes. These are things to consider. I mean, raising prices now when the consumer is a little bit more picky might not be the best choice. But overall, in the long run, will Disney still be here? Yes. Could they become more and more profitable? Probably yes. They will figure out how to run their streaming platform in a profitable way. So to conclude, is it too cheap to ignore? I think for those looking for a new position in your portfolio, for one that will be here for years and years to come. Not saying it's the cheapest that it can ever become, but it is becoming very, very attractive under $90. That's for sure. Will I be adding it to my portfolio? No, I'm not looking to add any new positions in the portfolio as of today. Could I reconsider in the future? 100%. That's just my thoughts. Leave yours down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.